The last part which I'm going to touch on now is professional ethics. Yeah, which is the last part in section A. After this, we'll move on to section B. Professional ethics. And what is ethics? Ethics is the best way of doing things that behavior that is generally acceptable, and that has minimal negative impact on all stakeholders. So it's about good behavior. It's about giving the best impact on all stakeholders. And why are we talking about it? We are talking about it because we want to preserve. So if you ask me why are we talking about professional ethics? The major reason is because we want to preserve professional performance and independence of auditors. That is the major reason why we are talking about this. We want to preserve the professional performance and independence of auditors. And you are expected to know the ACCA Code of Ethics in order to achieve this professional performance. And that I usually call pickup, if that helps you. That's ACCA professional. So I'll call this, you must know it. You call it ACCA Code of Ethics. You're expected to behave as an auditor based on all of these 5. And P stands for professional behavior, which means you should not be violating laws. You should abide by laws and regulation. That's what professional behavior is talking about. I is your integrity, which means you need to be someone of honest behavior. You're straightforward and you're not corny. So this is about honesty. And your C is confidentiality, which means you should not divulge information. Confidentiality. You need to make sure that you preserve the information of the client, except you have been given consent or approval to divulge. That's the only way you divulge it, or the only way out again is if it has to do with legal or court rulings, or you need to preserve the public sanctity. Then those are the only exceptions, but you must abide by this confidentiality. O stands for objectivity, which means you must be free of bias, and we'll talk about some of those things that might affect you that might prevent you from being objective. This is where your independence is really being tested. Independent, very important. That's what we're talking about, some threats that can attack your objectivity. And the last P is professional competence, which means you must go to school, you must learn, you must continue to improve your skills, and you must have necessary qualification and skills to be able to deliver a quality job on your client engagement. So these are the 5 code of ethics that you must know. But in as much as you are trying to achieve professional behavior, integrity, confidentiality, objectivity, and professional competence, there might be some struggles that might prevent you from being able to achieve those 5 code of ethics. And these issues are called your ethical threat. These are the things we want to talk about, the things that might prevent you from being ethical, things that might prevent you from being objective, things that might prevent you from being independent. They are called threats, and there are about 6 threats which you must know. The first one is self-interest threat. You have self-interest, you have self-review. Now we'll explain all of them. Please pay attention. You have self-review, you have familiarity. Some of them are very alike. Familiarity. You have advocacy. You have intimidation. You must know the meaning of all of them. Very examinable. And you can have what we call the management threat. Let me explain them. Self-interest threat is a situation that makes the auditors to put their own interest above the interest of the client or the interest of the shareholders. Remember, the auditors are working for the shareholders. So if the auditors have any reason to protect their own benefit ahead of the shareholders, then there's a problem. And an example of this is when you have things like gift. When auditors are being given gift or their fees that is tied to performance, then they want to give good opinion so that their fees can be huge. Or if client is giving them gift, they want to satisfy the management at the expense of the shareholder. So if management wants to hide something from the shareholders, auditors will support. So shareholders don't get the good service they deserve. Yeah. Also, if there are personal relationship with the client, maybe the auditor's partner or the manager or the senior associate leading the engagement has a girlfriend that is preparing the financial statement, or the CFO is his boyfriend or is her boyfriend or whatever, or their partners, or their brothers or their sisters or their fathers or mothers. Once the relationship exists, that relationship might be put ahead of the shareholders, right? A contingent fee is another one. Like I said, if the outcome of the audit determines how much fee you get, then there's a self-interest trust. Yeah. So the way I'm going to break it down, let's just take it one after the other. So take, for instance, we said self-interest. So what I will do is, for each of these traits, I'll give examples of how the traits can arise, because that's what you will see in the cases that you will be given in exams. And most likely when you have this kind of question, they will ask for safeguards. Safeguards is mitigation, which is saying if we have an exposure, how do we avoid that exposure putting us into trouble or making us not to achieve our objective of independence and providing a quality professional service to our clients. So I gave some examples for self-interest. We said gift. We said personal relationship with key staff of the client. Let's talk about contingent fee. Also spoke about lending to auditors. Lending to auditors. Right. So those are key examples that you can find. And what are the safeguards? Which mitigation? You need to avoid gift. No, don't take gift from client. Avoid except is seriously insignificant. That's the mitigation. Yeah, and if you have a personal relation with key client staff, CFO, people in charge of the account, the MD, the CEO, or whatever, then that kind of person should not be on the member of the audit team. So you have to avoid, so not allowed. There's no way to mitigate that than you just have to avoid it. So this is not allowed. So no such members should be on the engagement team. That must be taken out. Even if you already put the person there before and you discover that, then you need to take that person off. There's no other mitigation. And contingent fee is also not allowed as a mitigation. This is also not allowed. You cannot tie your audit fee on the outcome of the audit. Not allowed. Right. And lending to auditors as well must be done at normal market fair value rate. Yeah, normal market rate, and only by financial sector companies, so banks. So what I'm talking about is only banks. So I cannot be auditing Apple and Apple is giving us loan at market rate. That is not allowed. It's only allowed if your client is bank and also they are giving you at market rate, such that there is no beneficial rates involved in that transaction. Yeah. Another example of self-interest, which I also like to put, is fee. very low. It can be very low or high. Yeah, when it's very low, it's called low balling. Don't low ball. It's not allowed. You cannot be charging audit service very low because you want to have so many clients. That will put you under pressure. Yeah, because eventually you will discover that you are probably not even able to deliver quality work on all of them. Yeah. And high proportional fees from one client should be avoided as well. So you can't have too much high fee as well. So you need to avoid high proportional fees from one client. In fact, you are not allowed to have, so make sure you safeguard, yes, make sure you have less than 50% of revenue coming from one client. So what we are saying is that no one client should be contributing more than 15% of your annual revenue as an auditor. Because if that happens, then you'll be under pressure to satisfy that client, because losing that client will really hurt you bad. So that needs to be avoided. Yeah. And other safeguards that is very critical to talk about, especially for clients that have been with auditors for so long. Maybe you have a close business relationship with them, you've been auditing them for years, and eventually you've become friends. Yeah, so what we're talking about is close business relationship. Sometimes those business relationship becomes personal relationship when they have been there for too long. Yeah, this is as a result of long audit time. You have one partner been an audit engagement for 5 years, for 6 years, for 10 years. That can create problem for the auditor's independence. And what is the safeguard for that? Audit partner, I'll call it AP, that's audit partner, should not accept a key management position at an audit client until at least 2 years have elapsed. So there has to be, also audit partners have 2 years cooling period. So if you used to be audit partner on a particular client and you resign from the auditor's firm, you cannot join that client at least until after 2 years. So there's 2 years cooling period that you must wait. Yeah. You must wait for minimum of 2 years. Yeah. Before you can work for that company. This is just to make sure that you have independence and you're not going there to start covering up for your client. Yeah, very important, very, very important. And I'm going to also speak about self-review, which is the second one. Yeah, self-review. Very important to talk about self-review. Yeah. What is self-review? Self-review, self-review. So self-review is just when the preparer is also the one reviewing his work. You're the one that prepared the work, and you're the one that is coming to review the work. That is self-review. And what is the problem with that? Your independence is at stake, is at risk. Why is it at risk? It's very unlikely that if you find a mistake on your own work, you're going to expose yourself. It's very unlikely. Yeah, so, and that is why it is extremely important that any site of self-review threat must be addressed, right? So, self-review means you are auditing your own work. Yeah, take for instance, you have a secondee from your office. So let's look at examples, like the same format we've been using, and safeguards. Yeah. So, said for example, you have an audit member who used to be part of an audit firm. Yeah, say PwC staff has been sent to Apple to go and support Apple for some reason. Probably the person preparing financial statement of Apple has gone on maternity leave, and they needed such an urgent staff to come in, and PwC quickly gave them a staff to do it. So if that staff has prepared that financial statement, by the time it returns back to PwC, that staff must not come back as part of the audit team to audit Apple. If he dares do that, then that means there's a self-review threat, because he will not expose himself, will not expose his error or mistakes. So that is an example. So audit team member. Example is when you have audit team member who was previously working for the client. And you can see this can also happen if a staff of a particular company, say even for Apple, resign from Apple and joins PwC. That staff should not come back to Apple to audit Apple, especially if that particular staff has been in financial reporting role. Yeah, that is a self-review threat. Yeah, also when auditors give advice on accounting or control system, that is also self-review. Yeah, because it's still auditors that will come and review it. Yeah, so auditors give advice on accounting or control system and still audit the system. Yeah, because that's what auditors do anyway. They audit accounting and control system. Yeah. So that is self-review. Yeah. What do you do? This is not allowed. That's a safeguard. Remove a person. Don't put that person on that kind of job. That's a safeguard. Yeah. It's not allowed. Yeah. So, and if auditors will be given advice on some accounting or control system, then they have to find a way around it and what they need to do, because that's quite controversial. The best thing to do is to have different teams. Yeah. And what I would say here is different teams. Different teams must be used. Different teams must be used. There's no other way around it. Yeah. And if you even think you don't have enough members to be able to have different teams, then you need to refuse. That can be another good safeguard. So refuse one of the engagements. So choose whether you want to do audit or you want to give advisory. So refuse one of the services in order to preserve your independence as auditor. Yeah. But note this, there are, however, some notable exceptions in terms of provision of other services which cannot be allowed. They are abominations, not allowed. Like auditors must never prepare financial statements. Yeah. Auditors must never. So let me just put it critical. Critical exceptions. This one's no safeguard. It's not allowed. It is prohibition. Prohibitions. This is never. Auditors must never do it. So you can't talk of putting a safeguard in place. You are not allowed to do it. And there are 3 of them. Yeah. Do not prepare FS. Yeah. Do not carry out valuation for your client. It's not allowed. You cannot carry out valuation. And also, do not design an IT system for your client. You are not allowed to do these 3 of things. Never. Please take note. Never. You must not do that. So we've looked at self-interest, which is about auditors trying to protect their own interests at the expense of the shareholders. The self-review is when auditors review their own work. And the third one we'll be looking at now is familiarity. So we've done this. So we'll look at familiarity threat now. Familiarity threat, is just as the word familiar. So familiarity, because we have been together, because it's very close to self-interest kind of as well, because most likely if you talk about father and daughter now, father and son, they have familiarity and at the same time there's self-interest there, because a son will want to protect his interest with his father. So you can have some kind of interconnectivity in both types of threats. So familiarity threat usually is about showing sympathy. So you are protecting the person because you like the person, because you are familiar with the person, they are your friends, you have a relationship with the person, or you are even too trusting because you just know the person very well, you have comfort with the person, just assume that the person will do the right thing. And this usually happens when we have friends and family. We have friends and family, or we've been together for long relationship. Like I said, long business relationship. A partner has been on an engagement for long. A manager has been there for long. Or you have ex-colleagues. You know each other before, so you're friends. You're ex-colleagues. Right. So these are examples that I've already given. So let me just stay with our table that we've been using. So say friends and family. It's a long relationship and ex-colleagues. All these are examples. And what are the safeguards that we can put in place? You probably can relate with some of them because we discussed some of them in when we're talking about the self-interest as well. But this, I'll go very specific on this one, on safeguard, and please pay attention, because some of them can be a bit confusing, especially the numbers. So number one, no member of the audit team should have a close personal business relationship with the client. Is not allowed. So if you have friends and family with the client, you cannot be member of audit team. So this one is not allowed. So you can't manage this risk. You need to avoid it. Not allowed. Take the person out of the job, out of the engagement. Put them on another engagement. So, but long relationship, especially business relationship, when you have a partner that has been on an engagement for long, now you need to find a way to manage this. So this one, no engagement partner. Please take note. Engagement partner is a partner on the audit engagement. The number one person, the most senior person who is responsible for the audit, must never act for longer than 5 years. So engagement partner must not last more than 5 years. So less than 5 years on any engagement, so that they don't become too familiar with the client. And they should not return to that role for another 5 years. So it's less than 5 years plus 5 years cooling period before they can go back. Please take note. Engagement partner, that is the person responsible for the audit. That's the most important person on all the engagement. But you can have other partners. Maybe a tax partner, maybe another quality review partner. If there are other partners on the engagement, they must do maximum of 7 years. However, they can return back with plus 2 years cooling period. So see, not as long as the engagement partner, who is the main responsible party. Okay. So other partners, including quality review partner, like I said, that's what you need to understand. They have 7 plus 2, whereas the engagement partner is 5 plus 5. And like I said earlier, no audit partner is allowed to take job from their client until they have done 2 years cooling period. I said this earlier. No audit partner, no job with client until after you have done 2 years cooling period, which is what I spoke about here. Yeah. Please take note. Those are the key safeguards. So like we always do, examples and safeguards. Now, let's talk about the fourth one, which is advocacy. Advocacy threat usually is because of bias. And why are you talking about authors being biased? Authors are being biased because they are coming to defend their client. Yeah. So biased, the kind of bias we are talking about is when authors are biased in favor of the client, and can also be against. Yeah, please take note. Can also be against if they want to punish the client. The fact is just that they are not objective, they are not independent, because they are coming to defend or they are coming to say something bad about the client. Yeah, so an example, let's do our usual table. Yeah, so examples. Yeah, is when auditors is acting as a representation or representative of audit client, rep of client in legal case in the court. Yeah. Or you're involved in advertisement, you're advertising for your client. Yeah. You cannot be involved in any commercial advertisement. Yeah. No matter what. Your role is just to do your audit and leave. So don't advocate for client. And you will see that the safeguard is very straightforward. Yeah, it's not just allowed. You must never do it. Yeah. Auditors should withdraw from any engagement if they are involved in any serious litigation with the client. So if you're going to have taking your client to court, or your client is asking you to come and witness for them in the court, is not allowed. So if you have litigation with your client, then you cannot even audit that client, because you can't withdraw from your own litigation. However, if it's a client asking you to come and witness for them or to come and sit for them in a meeting so that they can get some kind of benefit from a lender or from what is not allowed as an auditor. Your job is to audit financial statement and issue opinion. Yeah, we're running it up. The last two that I'm going to speak about is intimidation threat. Intimidation threat. Yeah, intimidation threat is very similar to self-interest and even advocacy. Yeah, so the safeguard is also similar. So this is just very similar to self-interest. Because remember, intimidation threat is when auditors are afraid of losing something. Yeah, so because they are intimidated, like they don't want to lose their client. If you look at self-interest, look at this self-interest. Yeah. He's afraid of losing gift. He's afraid of ruining the personal relationship. He's afraid of losing his fee. Yeah, all those relationships. So, and safeguards are similar. So when auditors are afraid of all of that, then that is intimidation threat, and that is very similar to self-interest threat, and the mitigations are also the same. Likewise, if you look at the management threat, management threat is when auditors are taking management decision. So what I will tell you straight away is the safeguard is that auditors must never be in a situation. Auditors must never be in a situation where they are taking management decision. No, not allowed. Yeah. Remember what I said? The management threat is that auditors are acting in management capacity. They are making management decision. No, you must not do that. That creates stress on your independence as auditor. So that's it with the independence and the threats and safeguards, which is very important. And like I said, you need to make sure you understand these examples and how to mitigate them. And how to mitigate them are called the safeguards, because usually the question will give you case questions and they will ask you to identify what threats here are here and how can you mitigate them. So you need to know how to identify self-interest, self-review, familiarity, advocacy, intimidation, and management threat. Yeah, the most popular ones are these four, the first four. Those are the most popular, which are usually being tested. Like you see that intimidation is almost similar to self-review, and once self-review is tested, they believe that intimidation is also being tested. Okay, so that will be it for part A of the syllabus. The next series of videos will focus on part B. And until then, please remember, always like. I would like to hear from you. Send me a message, put a comment, share with your friends, subscribe to the channel, turn on your notification. We're on a journey and a wonderful one. I'm here to support your journey, help you simplify concept as much as possible. And I wish you all the best. Thank you. See you in the next video. Bye for now.